Hi guys, welcome back to today's video. So today I'll be going over 4 basic steps if you want to know how to choose a stock to invest in. So if you have no clue how to pick stocks or what to look at before you're able to invest into a stock, then this video is made for you. I'll be going over 4 fundamental matrix for you to consider before picking the stock that you want to invest in. So understanding these matrix will help you to differentiate between a horrible investment and a great investment so that you will know how to put your hard-earned money to good use. So I will also show you how and where to look out for information so that you will be able to do your own homework before investing into the stocks. So if this sounds interesting and something that you want to hear more, stay tuned and stay to the end of the video. So the first matrix that I'll be going over would be to see if the company has a competitive advantage or a economic moat. So the wider or deeper the economic moat, the safer the castle from getting attacked. So what that means in the company's perspective is that the stronger the economic moat the company has, the better the company is able to protect its profits and safeguard its business model from its competitors. So that way it will prevent its market share from being eaten up by its competitors. So if you don't have a moat, competitors can easily replace you and cut into your profit margin, take away your market share and take away your customers, and worst come to worst, eventually put you out of business. So never invest into a company without a competitive advantage and an economic moat, because for a long-term investing success, which is what I advocate and I hope everyone aims to achieve, you need a company to be around for that long and to be profitable in the future for the many years to come. So the only way to ensure that your money won't go down the drain or become a horrible investment is that the company remains competitive and remains strong in the business environment out there. So for example, Coca-Cola has been around for decades and they have an unbelievably strong economic moat. So there are tons of competitors out there making soft drinks, especially some companies that even directly try to copy the recipe and copy the taste of their drink. But because of Coca-Cola's strong brand name and their strong and global distribution network, none of the copycats have successfully replaced or eat up to Coca-Cola's market share. This allows Coca-Cola to remain its strong profit margin for the past decade and past decades, in fact. So if you invested in Coca-Cola a decade ago, you would definitely have become a millionaire by now, which is why Coca-Cola is a huge part of Warren Buffett's portfolio as well. So there are other modes out there, such as, for example, trade secrets. So what that means is that, for example, when your company has a patent over a certain product or patent over a certain technique, or maybe it's just that you can do this product in a certain way that no competitors out there that can copy or do the same. So for example, Pfizer, a medical company in the US, so what they do is they have a lot of patents for their drugs and medication so that only they can produce and manufacture these drugs to be distributed to the consumers in the public. So another mode is cost advantage. The cost mode is whereby you are able to produce your goods and services at a much cheaper prices than your competitors and nobody can get the same cost advantage like you. One example will be Walmart, where they are able to purchase their products at such bulk amount that they are able to bargain for a cheaper price at a wholesale price where the other competitors of Walmart cannot do. So that way you will be able to translate into a cheaper retail price and at the same time you're still able to retain their high profit margin. So then another type of mode is the network effect, where everyone uses the product and it's spread by word of mouth. So the amount of customers using that product is so huge that it becomes irreplaceable. So naturally the value of that product and the company would grow as well. So one example would be, for example, Facebook, because everyone uses WhatsApp, Facebook and Instagram on a daily basis. So naturally, if you are a business owner, you want to advertise on these platforms, you would have to pay Facebook for it, and naturally the value of the company will grow as well. So the last type of mode is a toll bridge mode. So what it means is that back in the days where, let's say you have to get from point A to point B and there's only one road, and at that road there's that toll that you have to pay. There's no way to get around it, and that's the only way if you still want to get from point A to point B. So one example in the modern world will be Google, because if you want to search something online, the largest search engine out there is Google. So you naturally would tend towards to use Google. So because of that, let's say you are a business owner and you want to advertise on Google, on the search engine, and you want your business to be searched online, you have to pay Google for it. So as you can see, there are various types of modes out there. So that's why it's important to know that when you make an investment, you should think about the kind of modes that the company have and how strong and durable that mode is. And if you ask yourself this question and you are unable to answer that, that just probably means that that company do not have an economic mode, and that just means that you should put that company aside and think about another better stock to invest in. So the second matrix that I'll be going over will be profitability. So of course, before you invest into a stock, you have to also look at how profitable the company is. So the best way is to measure that based on return on capital. So what you do is you take the company's net income in a year divided by its capital invested into the company. So that way you will get a number that will be expressed in a percentage. So you can either get these figures from their annual report or their financial statements, or you can even just go to platforms such as Morningstar, where they directly give you the figures right there. So return on capital is important because it tells you how profitable the company is and how good are they at making profits. So why is that important is because you cannot just look at the profit figures alone, because a company can be making a lot of profits, but they may not be efficient in making their profits based on how much cost there is and how much investment is put into the company. So for example, let's say I tell you that I have a company and I made 100,000 of profit last year, but the capital invested into my company was, let's say, 10 million. So that will mean the return of capital is only a mere 1%, which is considerably quite horrible. Whereas on the other hand, let's say I also still have another company that makes 100,000 profit last year, but the amount of capital invested into the company is only 10,000. That will mean a return on capital of 1,000%, which is tremendously great. So you can see the difference that you cannot just look at the figures of net profit alone, but you have to compare it to the amount of capital invested, which is why return of capital ratio is such an important thing to look at. So if the company has a high return on capital, it will naturally mean that they do have a strong economic mode and the business model is great and the operations are run well as well. So as a rule of thumb, you want to look at a company's return of capital that is positive, definitely not negative, because that will just mean that the company is not making money at all. So you will want to ideally get a double-digit return of capital on the company that you want to invest in, because based on the example given, that is just highly unrealistic and I just exaggerated the figures because there's no way that a company will have 1,000% of return on capital. So as a point of reference, Coca-Cola has a return of capital of about 20 to 30% in that range over the past decade. So I will also continue making more videos in the future to break down specifically more financial ratios that you can look at so that you know how to better analyze the company and really invest into a strong company. So the third matrix that I'll be going over will be price. So let's say you have found a great company that you understand, it has strong financial figures and there is a good economic mode there. What is the next thing that you have to look at will be the price of the company. So even the best investments would become a horrible investment if you bought it at the wrong price and bought it at an overvalued price. In order to be able to determine how undervalued or overvalued the company is, you have to look at this thing called price earnings ratio, also called PE ratio. So the PE ratio is essentially a matrix that tells you how expensive or cheap the company's stock price is relative to their company's earnings. So what you do is you take the company's current stock price divided by the company's retained earnings per share. So when you look at stock prices, similarly like profitability, you don't just look at the raw figure itself, you look at it relative to other factors. And in this case, you look at it based on their earnings per share. So generally, you want to invest in a stock with a low PE ratio because that means that the company's stock price relative to their intrinsic value is undervalued. So there's a lot more room to grow and a lot of room for the stock prices to rise over the years that you want to hold it for. So I will come up with a stock investing checklist where you can sort of refer to, and it will serve as a step-by-step guide for you to know what do I have to look at, what figures do I have to look at, where do I get these figures and information, and ultimately derive at the conclusion of whether or not to invest in the stock. So the last matrix that I'll be going over would be looking at debt, the company's debt. So before investing, it's important to know how much debt that the company holds, because debt is not necessarily a bad thing, but you have to be very careful when a company is consistently having debt and having a huge amount of debt, because you also have to look at what are the company using the debt for. Are they using the debt to expand their operations, build a new factory, and eventually down the road increase their profitability, or are they just using the borrowings to cover for their losses or to cover for their liabilities? So the rule of thumb is, as long as the company has sufficient cash flow to pay off the interest and the principal every month, then the company is still in a strong financial foundation. If you see that a company has a huge debt on its balance and on its balance sheet specifically, and it owes so much that it will take forever to get out of debt, these are red flags that you have to look out for. And it just means that this company is not healthy and it's not running well and it's not being in good financial position to pass through any hardships. So how you get the figure is you take the long-term debt divided by its free cash flow. So that will arrive at your debt coverage ratio, which will eventually, what that means is that it tells you the number of years that the company will take off to pay off the debt that it has right now. So let's say if you get the number of 3 years or lesser, ideally, that will be a good guideline to serve as to what you look at. Because let's say if you see the debt coverage ratio comes out to be 10, it means that the company takes 10 years to pay off its debt, which is not a good thing, because it will mean that for 10 years is technically not making any money. On the other hand, also, you do not want to invest into such companies that are being very unstable, because it means that they cannot breach through any risky situations at all. So for example, in this year, when COVID-19 hits, a lot of companies turn bankrupt or run out of business is because they do not have a strong financial foundation to back them up. So they think about it, the company still have to pay off constant debt every month without generating the consistent revenues that it's used to. So it will then be put in a very risky and unstable position where the company has no idea whether it's able to support itself. So the company may even have to end up being declared bankrupt, and in the worst case scenario, it might even be delisted, which means that your money really goes down the drain. It's not even any portion of losses anymore, it's just completely all of your hard-earned money is gone. So if you stick with strong and financially sound companies, there's no risk pertaining to this. So that's why you have to be very careful about analyzing and really understanding the company that you're investing in, so that you make sure that you end up with a good investment and not a horrible investment. So with that, we have come to the end of this video. So what stocks will you be buying and why will you be buying that? So please feel free to leave a comment down below and tell me what you think. So if you like this video, please hit the subscribe button and share this with your friends, so that we can motivate each other to make better investment decisions in the future together. So thank you for watching and see you in the next video. Bye bye.